This is MacroVoices with hedge fund manager Eric Townsend, the free weekly financial podcast targeting professional finance, high net worth individuals, family offices, and other sophisticated investors. MacroVoices is all about the brightest minds in the world of finance and macroeconomics telling it like it is, bullish or bearish, no holds barred. Now, here are your hosts, Eric Townsend and Patrick Ceresna.
Let's move on to this week's Postgame chart deck, which is titled Sizing Up the Liquidity Event Risks. Listeners, you'll find the download link in your Research Roundup email. If you don't have a Research Roundup email, just go to our homepage, macrovoices.com, click the red button that says Looking for the Download. Patrick, Sizing Up Liquidity Event Risks. Page 2, we got the S&P 500 futures chart. Boy, taking a nosedive there, and it's all started right after that CPI print.
Yeah, Eric, let me just start off by making one bigger point, which is that fundamentals matter, and they matter over the long term. But over the short term in the markets, liquidity is the driver of short-term volatility that converges or diverges away from those fundamentals. The thing is that when we enter a period where there's margin calls and liquidity, it doesn't matter the quality of the name. Everything sells under those conditions, and the correlation of all assets goes to one. And so the bigger question that I'm trying to ask is that have we now started to transition to what you in the market wrap at the beginning were talking about, where something bigger may happen? And one of those things that starts to emerge is when it stops being sector rotation to everything selling all at once. And if you look at and reflect on the first 4 or 5 months of the year, we had very clear sector rotation. We had strong performance in utilities, strong performance in some of the healthcare names, in some of the consumer staples. There was defensiveness in those high dividend paying kind of stable names while it was rotating out of tech. And we saw the selling in really a specific sector group. But what we have now seen in the last week was there is nowhere to hide. And so I want to start on page 3 and really reflect on the fact that, and when you look at the heat map of the last week, there was nowhere to hide, no sector that was safe. Everything, including energy stocks, have been selling throughout this cycle, which is like one big, almost margin call on the whole market. And when you look at the way that the market reacted, going back to page 2 on the S&P, and to the Fed giving the market basically what they priced in, we had about a 100-point intraday rally, which was not even close to a 50% retracement of the 3 days of carnage that happened earlier in the week, and immediately rolled over and sold. This is starting to be a very worrisome amount of selling. Now, typically when you hear worrisome, you think that, well, the oversold conditions are bad. Sentiment is probably the worst we've seen. It must be close to a bottom. But yet we have not seen panic. Look at page 3 and just look at volatility and the VIX. When you think of March 2020, when we were on MacroVoices here talking through the COVID crash, I mean, volatility was blowing out. There was crazy moves in the market, and people were grabbing at volatility premiums and gamma to be able to hedge out risks. But yet, look at where we are today. We have not seen any genuine fear reflected on the willingness of people to pay up for volatility premium. And to me, that means that we have not yet seen the capitulation moment in the selling. And that's, to me, a little bit scary. Now, I don't want to say that I can guarantee a market crash or that there's any certainty. But the thing is that if anyone is trying to already call a market bottom, because I don't see the signs yet. And therefore, I'm kind of approaching this as a strap on the seatbelts, because there's a lot of things that can happen here, and we're breaking through key technical levels, and stress points are being cracked. And once we get past this option expiration this weekend, which could arguably pin the market going into Friday, but after that, there's a lot of things that can go wrong, and I'm playing defense. I've hedged a lot of the things I own, and I'm raising a lot of cash. What's your take on that?
Patrick, I agree, but I think the emphasis, at least to my thinking, is primarily on inflation. The reason we saw that relief rally that got us back up almost to the 50-day moving average was because people thought that the peak for inflation was in and that it really was going to be transitory and so forth. Then we saw that runaway CPI print last Friday, and really the bottom has fallen out since then. And as you said, Patrick, we have yet to see anything resembling crash conditions. What we've seen has been a 20% sell-off in the S&P, but it's been a very orderly sell-off. It really has not been a crash. What we've seen in the last week is starting to look like the beginnings, maybe, of a crash. And if so, this is just the beginning. So I think that the S&P bottoming in October or early November in some kind of a two-handle below 3,000 is entirely possible. Let's move on to the euro-US dollar cross, which we have charted on page 5.
Yeah, this is, to me, still the chart to watch in the currency markets. While we have had this extraordinary move on the yen and the JGBs just had a crazy break as the yield curve control thing is starting to be put into question. And we've seen even the pound sterling break to a lower low. The euro has resiliently not broken and held the May lows. And this is the big question for me, because once we break to a lower low, that low in May is not just the 52-week low, but that's actually where the decade low is for the euro. And once we break below that level, not only is parity in sight, but maybe even we would see something fall under parity for the first time in almost 2 decades on the euro. And that would certainly put in motion a significant US dollar move. And so to me, my eyes are on this euro to see whether or not that level holds along that previous low, or whether or not that we're going to see that break next week.
Well, Patrick, now that I see this chart, it really helps to make the case that maybe that breakout we saw to a new high on the dollar index was a fake break after all, because as you just said, what we really were looking for was for a further breakdown in the euro to a new low, and we didn't get that. The dollar index breaking out to a new high sounds like it happened because of the yen, not because of the euro, and yeah, that counts, but I think, as you said, the real test is the euro breaking lower. So it'll be interesting to see what happens there. Let's move on to page 6 in the deck. I don't know if I should interpret you adding a Bitcoin chart as meaning that you've suddenly become a coiner. What's going on here?
Well, listen, I just wanted to technically observe the really difficult time cryptocurrencies are having. And obviously, there's all sorts of stable coins that are blowing up right or left. But really, the big boys like Bitcoin and Ether are struggling here. And we had a tight trade range from over a month in Bitcoin that just like 10,000 points drop just happened within a week, and the carnage is there, and the momentum to the downside is just, it seems unstoppable at this stage. It'll be really interesting to see whether or not 20,000 holds this, or whether we're going into the teens on the Bitcoin price. But such a distinctly clear bearish downtrend, and it's just coming to some key round numbers, and I'll be really curious whether that holds the line here.
We just got an email from one of our listeners who owns a restaurant and told us that a whole bunch of restaurant employees have been lost in the last few years because they all got rich on Bitcoin. They're all coming back looking for jobs working at minimum wage in restaurants again. So I don't know if that's a meaningful economic barometer or not, but it's one data point. Let's move on to crude oil futures on page 7, my favorite topic.
Yeah, and I took this snapshot a couple hours ago, and it's quite old now all of a sudden. There was quite an intraday reversal. You know what? To me, the interesting part and it still, I think, it remains a little bit of a risk, because while we heard that great interview with Anas, I still think on the short term, if we have a liquidity event and a margin event, then there's a chance that oil temporarily gets trapped in a liquidity event. And I still would view that as a buy on dip. The bigger question is there, are we going to see some of that selling pressure kind of spill temporarily into oil that will offer that buy on dip, or is it already done and just upside from here? Like while I remain bullish oil, it is hard for me to imagine the entire risk asset intermarkets all selling and oil just ignoring everything and just trucking along onto the upside. I think that there's going to be some short-term volatility here, but it's probably a buy on dip on any opportunity that's offered.
I agree, but I think it's a deeper dip than we've seen so far. I think we could easily get back down to $100 or below $100 just on the market coming around to recognize that a recession is coming for the U.S. One of the things I thought was interesting about Jay Powell's presser, one of the old adages in media is that the first step in confirming a speculative rumor is when it's officially denied by the government. Well, Jay Powell went out of his way to say explicitly that the Fed is not trying to intentionally engineer a recession. So take that as you will in terms of what it might mean. When the rest of the market comes around to recognize something that we've been talking about on MacroVoices for months now, which is that a recession probably is coming for the United States, I think $100 test or so or lower than that to sort of wash out the speculative froth is definitely in the cards. But then the fundamentals will kick back in and we move back up to higher prices.
Right. I want to move on to the nat gas chart because there is a much clearer correction that is evident there. The oil obviously recovered much quicker, but nat gas broke pretty heavily, and it kind of reflects a lot like the correction we had in May. The interesting part to me will be back in May, after that 2-day little quick drop, the bulls just got right back to business and took natural gas again to higher prices. I think the big price action thing to watch in the next week is, are we going to have a repeat of that type of price action where we got a quick correction and the buy on dip traders quickly work this right north of $8 again and get nat gas going on the upside? Or is it different this time where the rallies start failing and maybe some short-term tops start to emerge on nat gas futures? Like we and you were talking about the term structure on nat gas and how it's not really pricing in higher nat gas prices beyond the 2022 period on the term structure. And it will be interesting to see whether nat gas goes through a little bit of a deeper correction here and we see more some of that backwardation get taken out of the market. Any thoughts on that?
Well, Patrick, I think the real story on natural gas is going to center on what happens to Europe, particularly as we get into the fall and they need Russian natural gas for heating, and potentially they can't get it unless they pay in rubles, and what all the consequences of that are going to be. I think the reason that we saw such a pronounced sell-off in natural gas was because of an explosion in a natural gas facility in the United States that caused a lot of people to think that it meant that the U.S. was not going to be able to export as much gas to Europe as originally planned. And so that explains why we've seen that volatility. But at the end of the day, we're going to get to a situation before the summer is out where the world realizes that there is no alternative to natural gas for heating Europe in the 2022-23 heating season. And if you can't get the gas and Russia doesn't want to sell it to you, or they'll only sell it in rubles and you can't get the rubles, or, there's so many things that are coming, I think we're going to see global natural gas prices to the moon. Now, it's entirely possible that if there's a change in U.S. policy and the promises to export so much natural gas change for some reason, well, that could change the equation to the downside in the U.S. But short of that, I think it's much higher in nat gas prices.
All right, well, let's move on to the gold chart because, you basically were highlighting the way that I was reflecting on the little rally we had today. And just to give some validation to your point, the argument I was saying was simply the fact that it's not down like everything else today, but like the chart is still distinctly a bearish chart. There is no evidence of a new uptrend in any way. I mean, it did find support along the 1800 level along the low. low. During a liquidity event, we certainly have room to retest some of those lows towards 1750. And that is the reality, I think, on the short term of gold. But it is at least interesting that we're not seeing the US dollar rallying much, and we've seen correlation in the last half year very much stick with gold behaving very much like a cross currency to the dollar. So I think watching what happens with that euro will actually correlate a lot with what gold's next move is. One way or another, I think that there will be a great buying opportunity on gold, but on the short term, you're right that there is not an uptrend, and there is no evidence of a reversal beyond just one little up day. I think there's still a lot to be determined here in gold going into the summer.
Let's move on to the 10-year yield on page 10.
Right, and I just wanted to highlight that just to again reconfirm what you were saying, is that once we cleared 3%, it clearly was the kind of fear moment as yields started to really blow out. Right now, there are a number of these ways to approach this. I mean, I think at this stage, 4% is not out of line. And while we certainly have seen the last few days in the post-FOMC, the yields kind of stall out a little bit. And it would be actually technically significant to me if we didn't hit 4%, because that would actually be divergent momentum if we see stalling here, as it would really kind of start to show that we're reaching the kind of upper boundary of where this was going to go before recession kicks in. Now, I'm not trying to make any bold call here, but it would be a natural move to see this work its way toward 4%, and it would be significant in my mind if it didn't hit it. And that's certainly going to be something I want to watch with our listeners over the going into July.
Folks, if you enjoy Patrick's chart decks, you can get them every single day of the week with a free trial of Big Picture Trading, Patrick's trading service. Sign-up information is on page 11, or just go to bigpicturetrading.com.
That concludes this edition of MacroVoices. Be sure to tune in each week to hear feature interviews with the brightest minds in finance and macroeconomics. MacroVoices is made possible by sponsorship from BigPictureTrading.com, the Internet's premier source of online education for traders. Please visit BigPictureTrading.com for more information. Please register your free account at MacroVoices.com. Once registered, you'll receive our free weekly Research Roundup email containing links to supporting documents from our featured guests and the very best free financial content our volunteer research team could find on the internet each week. You'll also gain access to our free listener discussion forums and research library. And the more registered users we have, the more we'll be able to recruit high-profile feature interview guests for future programs. So please register your free account today at macrovoices.com if you haven't already. You can subscribe to MacroVoices on iTunes to have MacroVoices automatically delivered to your mobile device each week free of charge. You can email questions for the program to mailbag@macrovoices.com, and we'll answer your questions on the air from time to time in our mailbag segment. MacroVoices is presented for informational and entertainment purposes only. The information presented on MacroVoices should not be construed as investment advice. Always consult a licensed investment professional before making investment decisions. The views and opinions expressed on MacroVoices are those of the participants and do not necessarily reflect those of the show's hosts or sponsors. MacroVoices, its producers, sponsors, and hosts Eric Townsend and Patrick Ceresna shall not be liable for losses resulting from investment decisions based on information or viewpoints presented on MacroVoices. MacroVoices is made possible by sponsorship from BigPictureTrading.com and by funding from Fourth Turning Capital Management, LLC. For more information, visit MacroVoices.com.